Welcome, everybody. Thank you so much for joining us for another one of our lunchtime webinars. These webinars are focused on delivering as much content as we possibly can cram into your brain. So I hope you guys brought a good, healthy lunch, not too many carbs, and you're ready for this because we are so fortunate to have Cherry Chan as our guest today. We specifically chose January for Cherry to join us because we know you guys, it's the start of a new year. Some of you might have incorporated it or decided to set some really big goals to scale things up. We know accounting is one of those things. I don't think there's very many of us who are like you, Cherry, who love accounting and numbers, but we know it's so important. So that's one of your awesome, unique qualities. So our agenda for today, and I'm going to try and be really quick here, but our agenda for today is to do a quick welcome and introductions. Then we have Cherry doing her presentation. We're going to try and get to a Q&A at the end, and then we're going to do a quick webinar wrap up. So just a quick housekeeping for those of you who this might be your first time in one of my webinars. I am one of those people who likes to use the Q&A. So I love the chat box for us to be able to interact. And, if Cherry asks a question or if, someone wants to comment, we love the chat box for the interaction. If you have a specific question for Cherry that needs to be answered, please use the Q&A tab, because I guarantee with the number of people registered for this webinar, unfortunately, your question will kind of get swept away in the conversation. So the chat box is to interact, and the Q&A is where you put questions up for Cherry to answer. She will do her best, as I know she always does, to get through the questions. Just a reminder too, in the chat box, you will see there is a 2 with a little drop down. Zoom defaults, for whatever reason, to only sending the messages to panelists or hosts, or it names a couple of people, but basically the people who are here in an admin position. We want to change that to, depending on your version of Zoom, it might say everyone, or it might say all panelists and attendees, or whatever it says. Make sure you change that drop down, because otherwise you're just talking to Cherry and I, and nobody else in the Zoom presentation is seeing it. So don't forget your drop down, and don't forget to use the Q&A for specific questions. I, of course, am Elizabeth Kelly. I am your host for, this is another one of our awesome lunchtime webinars. And I am so honored to have my friend Cherry Chan with us. Cherry is a overqualified accountant who is in the process of building an extremely successful business dedicated to helping real estate investors know what they need to know in order to build and scale really successful businesses, all while adhering to government requirements in terms of accounting, right, Cherry? Cherry is also a successful author, and I'm really proud to consider her one of my friends. So there's a number of questions that came in before the webinar that were questions, but what we're going to do is we're going to let Cherry get started, and we'll see where we get to with our questions, and we'll try and have time to answer everybody. So Cherry, thank you so much for joining us today, and over to you.
Awesome. Can you see my presentation?
Absolutely. It's very brightly colored. I love it.
Okay, it's full screen and it's just one thing there, right? Okay.
Yes.
Awesome. Thank you. Thank you so much for having me, Elizabeth. This is always an honor to be able to speak to your audience. So I generally speak really fast, probably because I'm nervous. It's not my first time doing this, but I still get nervous. And I noticed that every time I do a presentation, I speak really fast. So I'm going to go with that because I crammed 2.5 hours of material into this presentation. I won't be able to finish them all, but I'll try my best to finish as much as possible. And I understand that there are some questions that are already coming in. If you have questions, feel free to leave it in the Q&A. I'll try to answer as many as possible, but I'm pretty sure a lot of these questions would be answered as part of my presentation. So today we're going to talk about accounting 101 for real estate investors, specifically real estate investors. A little bit about myself. Thank you for Elizabeth's great introduction. I am a published author. I have published 2 books. One was published in 2017, the Real Estate Canadian Investing Complete Taxation Guide to Canadian Real Estate Investing. The Real Estate Agent book was just recently published last year. These 2 books have gotten me really far and have been able to help me to achieve the goal of helping helping me to achieve the vision of being the guide to hardworking Canadians seeking financial freedom. So if you haven't got the book, lucky for you, we're preparing this book for as a gift to Elizabeth to host this webinar. We're giving it away, the soft copy, for free. It is currently selling for $26 online on Amazon, and it has been the Amazon bestsellers in this particular category for the last few years. So you are going to get it for free. You just need to go to realestatetaxtips.ca, my website, /investors. So realestatetaxtips.ca/investors, and a copy of this book is going to be sent to you. This book is a compilation of all the blog posts in an organized format that you would need to help you, to handhold you in terms of documentation and then structure your real estate long-term portfolio. So realestatetaxtips.ca/investor is your link. Now let's get started. Oh yeah, I also am on these social media. Everything's is Real Estate Tax Tips, Facebook.com Real Estate Tax Tips, or YouTube.com Real Estate Tax Tips. I'm on all these platforms. Follow me if you have these platforms as well and you want to stay on top of the latest tax tips. Today's agenda, we're going to talk about bookkeeping essentials for real estate investors, and then we're going to talk about understanding the Canadian tax system and the 6 questions that I generally go through to decide whether you should set up a corporation for your investment. I probably would not have enough time to go through the common corporation structure, but I have it in the presentation just in case I have some extra time. Now, a little bit of disclaimer to start off. I'm a real estate accountant, but I cannot be responsible for everything I say here today, because your situation could be very different from Elizabeth, could be very different from Mary Beth, or could be very different from your neighbor across the street who's also investing in real estate. So one size doesn't fit all. If you are interested, make sure that you come to us and schedule a consultation. You can welcome to go to your accountant to schedule a consultation. Make sure you work with someone who knows real estate accounting and also knows your situation very well. It's not easy to answer questions unless we know all your complete picture. Okay, what can you deduct as real estate investor? The bookkeeping essential part of our presentation. Now, so because it's tax season, we are starting to get a lot of tax returns, tax inquiries coming in. And one of the things that we educate our clients on is how do they deduct and what can they deduct as real estate investors in general. And this applies to whether you are in holding your portfolio in your corporation or holding your portfolio personally. It still applies. Now, the first rule is it's something that I call general deductibility rule. If you think you can establish some cause and effect relationship between incurring certain expenses and earning the income, chances are you would be eligible to deduct some expenses. It's subject to a bunch of exceptions, but the rule is that you must be able to establish the cause and effect relationship between incurring the expenses and earning the income. Now, let's step back. What does that mean? You are now earning rental income if you are purchasing a rental property for long-term buy and hold. So you're earning rental income. What would you need to spend on to earn that particular rental income? For example, you need to spend money on maybe advertising, maybe your mortgage, mortgage expense, mortgage interest expense. Maybe you need to spend money on hiring a real estate coach. These are expenses that you incur for the purpose of earning your rental income that allows you to generate the rental income, and therefore they could be deductible depending on the particular situation and the details of your documentation. If they are deductible, then you need to keep the receipt. Anything that you think that would help you to generate the income you should always keep those receipts. Anything that you think that there is a cause and effect relationship, keep the receipts. If there are no receipts, there are no deductions in CRA size. It sounds simple enough. The truth is, your bank statements and your Visa card, credit card statements are not considered evidence, are not receipts. They are, in reality, they're just paper record. CRA doesn't accept those. So you actually need to keep the paper receipts. If you take someone out for lunch, take your tenants out for lunch, or buy your tenants a Tim Hortons, a bunch of Tim Hortons as a welcome gift, that Tim Hortons receipts would have to be kept in order for you to deduct that expense. Just because it show up on your bank statements or your credit card statements, they don't count. Now that we understand our general deductibility rules, we can go into details in terms of what you can actually deduct as real estate investors. Now, first of all, finance charge is deductible. Like, what is considered finance charge? Finance charge is includes, like, for example, something like CMHC insurance for a lot of multiplex unit investors. If you purchase you have a mortgage with CMHC, purchase the CMHC insurance, that CMHC insurance is tax deductible over 5 years. It is part of your mortgage, but then it gets to be deducted over 5 years. Now, sometimes it's not obvious. The reason why I call it out, specifically calling it out here, is because it's part of your refinancing or financing documents. And a lot of the time it's not showing up in your mortgage statement as the standard thing that you get asked by your accountant. So those are things specifically that you should keep in mind for your year-end preparation. Now, mortgage broker fees or mortgage lender fees, right now, a couple of years ago, I started working with a credit union. And when I work with credit union, I'm required to pay a commercial loan application fee. That loan application fee is also tax deductible over 5 years. That's part of the finance charge. If you use private lender, or some mortgage brokers also charge a 1% lender fee, those lender fees are also deductible, but it is over 5 years. The documentation that you need to keep for your finance charge, it would be your closing document. Whatever that statement that would show that you have already made that payment. Now, second thing is line of credit interest. I always say that it is extremely difficult in Canada to save money from your day job. That's just because our tax system is so expensive. We have to pay so much tax. The only way that we are like in my situation and a lot of my clients' situation, the only way that they are able to find the money to invest is through their home equity. So they refinance their property, borrow against their home, and then take out a large sum for real estate investment. And the interest that you incur for this line of credit or on this particular mortgage, the investment portion of it is tax deductible. And the only thing that you need to do with that is that you need to make sure the monthly line of credit statements at year end is available for you, so that you would be eligible to deduct the line of credit expense. Now, just so you know, not if you use the line of credit also for personal use reason, let's say you have a line of credit for $200,000, $180,000 of it is for investment purpose, and $20,000 and you use it for a Disney trip. I really hope that we can go back to Disney very soon, but let's say you go to a Disney trip. So in another word, 10% of your line of credit is used for personal reason. 90% is used for investment purpose. Only the 90% of the line of credit interest would be tax deductible. So you need to prorate it. The second thing that you need to pay attention to with your line of credit is, like, maybe after you spend this much money, now you got a bonus from your job and you get $20,000. And in your head, you may be thinking, hey, I'm taking that $20,000 bonus from my job to pay off the $20,000 that I incur for personal purpose. So that payment, the $20,000 payment, is being applied proportionally to the entire line of credit. 90% of the $20,000 repayment would go against your investment, not loan. And then the other 10% would then go against your Disney loan. So as soon as you mix the use, the repayment will always be proportionally assigned. And so in another word, what it means is that if you don't have two lines of credit, you only have one line of credit and you use a portion of it for personal use, your future interest deduction will always be based on the proportion that you initially set it up. So it is very important to understand that, because then the way to go around it is to set up a second line of credit or a sub line of credit to separate the two use of line of credit, to make sure that you can maximize the deductions on your investment loan while you minimize the expense that you would incur on your personal loan. Now, mortgage interest is tax deductible. We mentioned that under the general deductibility rule. Going with that, obviously property tax, utility bills would also all be tax deductible. Your home insurance would be, your rental home insurance would be tax deductible. Property management fees is the same way. Accounting fees and bookkeeping fees would be tax deductible for the purpose of preparing your statement of real estate rentals. Accounting fees to do your personal tax return would not be tax deductible. But accounting fees to do the corporation tax return, however, would be tax deductible. Repairs and maintenance is deductible. It gets a little bit more complicated. On my blog, I have like 4 or 5 blog posts just on repairs and maintenance alone. The reason why repairs and maintenance are so complicated is because repairs and maintenance can easily be mixed up with capital improvement in the eyes of CLA. To us, real estate investors is the same thing, like we're renovating. But in CLA's eye, when renovating can actually be distinguished between repairs and maintenance, which in CLA's eyes is also called current expense. Current repair and maintenance expense can be deducted against rental income, but capital improvement of your property is being capitalized, being added to the cost of your building. When you eventually sell it, you can deduct it. But if you're not selling it in 10 years, you're not going to get the deduction until 10 years later. So it gets a little bit more complicated. The general rule is that, are you improving the property? What is improving the property? For example, using roof replacement as an example. If you purchase a property, you rent it out, it's already set up, and then a couple of years later, the roof needs to be replaced. Now, the roof was a basic roof. It has like the standard 20 years life. And now you're replacing it with the basic roof, also 20 years life. You're replacing it. Then I would be able to deduct it with the same quality. The key here is that you replace the existing parts of your building with the same quality. You would then be able to deduct it as repairs and maintenance. However, if you upgrade the roof from regular shingle roof, basic regular long-term shingle roof, to a metal roof, so it's purely an upgrade, then that metal roof cost of like $10,000, $20,000 has to be added back to the building, added to the cost of the building, form a portion of your adjusted cost base. When you sell the property, you can claim that if you purchase a property for $500,000 and spend $20,000 on your metal roof, then now your cost is $520,000. So now there are some exceptions to it. If you intentionally purchase a new house, an older house, which a lot of us are in the market of purchasing resale homes. When you buy resale homes and you know that the roof have to be replaced immediately after you purchase it, and you spend the money to replace it immediately after you close the property. You're buying an older property and do a bunch of improvement to get it ready for rent. The cost of those improvements that you made would have to be added to the cost of the building, like the capital improvement. That's how CRA look at it. Even though if you do it in between tenancy, those expenses would be considered repairs and maintenance that you can write it off against your rental income. So unfortunately, those are the rules that CRA is going with right now. Now, why is it so important? Because repairs and maintenance is 100% tax deductible against your rental income. When it's being added to the cost of the building, when you eventually sell it, using my previous example, the $500,000, you purchase a property and you upgrade your roof for $20,000, that $520,000 cost, when you eventually sell it for say $600,000, that $80,000, if it is a long-term rental, that $80,000 is only 50% taxable, at least as of right now. The government hasn't announced any tax increase on sale of rental property. So that $80,000 capital gain is only 50% taxable. Only $40,000 is taxable. What it means on the flip side, when something is being added to the cost of the building as a capital improvement, means that the expense is only 50% deductible. Repairs and maintenance, current expense, 100% deductible. Capital expenditure, 50% deductible. So you always want it to be called repairs and maintenance as taxpayer. Government always wants to call it as capital improvement because then they get more tax from you. Now, then that leads to capital cost allowance. Now, capital cost allowance is a way that CLA recognize the tear and wear on the property, on the building itself. So if you purchase a property for $500,000, same example, you would be able to claim a portion of that $500,000. Basically is 4% a year annually. You would then be able to claim 4% annually against your rental income. However, capital cost allowance is something similar to RSP. For those of you who are familiar with RSP, the year that you make the contribution, you don't have to pay tax. Capital cost allowance, the same way. The year that you claim capital cost allowance against your building, you do not need to pay tax that particular year. But similar to RSP, the year that you withdraw money from RSP, you take that RSP back to income. It's being added as part of your income. Now, in the case of capital cost allowance, the year that you sell the property, the entire amount that you claim as capital cost allowance all through the years would have to be added back as rental income the year that you sell the property. So it is a tax deferral mechanism that's available for you to use if you want to defer taxes to the future year when you sell the property. But it isn't a tax deduction write-off that you would never need to pay back. It is something that you would still need to pay tax on. And sometimes, truthfully, it could catch people off the guard because they weren't expecting to pay taxes on the capital cost allowance recapture. Now, what other deductions are also available? Bad debts. Now, the reason why I mentioned bad debts is all those uncollectible rents. The reason why I mentioned those is because typically when we are all rent as real estate investors, we're not really thinking about documents that we need to keep for CLA. We're only concerned about how we would be able to deduct the expense or not report the income because you never received the income. Unfortunately, my experience with CLA is this: when you get audited for on your statement of real estate rental, when you get audited on your statement of real estate rental, the first thing that they ask is your lease agreement. Now, if you have a lease agreement and it says it's from January 1st, 2022 to December 31st, 2022, if the tenant move in January, it's fine because it's the first month, and then stop paying you February, March, April, and when you get audited by CLA, you provide that lease agreement. CLA automatically deem that you have received that lease agreement, or all the lease amounts based on the lease agreement, unless you can provide proof that you did not receive the money. But how would you provide proof? Well, he didn't pay me, he didn't pay me. Like how would you be able to prove that? So I've had a situation with a client whereby he had all the communication done over phone calls. So the tenant wasn't paying and he wasn't collecting money. So he kept calling the tenant and the tenant kept deferring it. And so he never had any paper record, any paper trail, any electronic trail. It could be tax, it could be the, I don't remember off the top, the landlord-tenant boards form, but it could be that form, it could be the email that you're chasing after the tenant, you did not pay rent. Those are extremely important documentation that you have to keep to show CLA that, hey, they did not receive the rent. Well, I did not receive the rent, they did not pay, therefore I'm not reporting that as income, or I'm recording it as bad debt. I cannot, it's uncollectible rent. I know a lot of us are not really paying attention to it, and that's why I want to bring that up, because I've seen taxpayers paying tax on the amounts that they've never received. Now, going back to the same thing, condo fees, bank charges, if you have a dedicated bank account, the bank charges would be tax deductible. Condo fees would be tax deductible. You would need to be, a lot of the time, you would not get a monthly statement for your condo fees, but at least you would get an annual condo fees increase notification. Every time they want to increase your condo fees, you will get a notification at least. So that would be helpful. Membership fee, events, you would be, I can't say 100% at all, you would be able to deduct the expense without issues. It depends on the type of how lucky you are. I've seen membership fees like a membership on multiple real estate clubs, investment clubs, or meetup events cost. I've seen them being deducted and going through without problem. And I've also seen it being questioned by auditor. The reason is because sometimes when you join membership fees or events, remember our cause and effect relationship, the general deductibility rules. If you remember that, CLA may or may not be able to see the two together. So they would not be able to see, hey, how do you join this particular membership? And how did it actually help you to bring in the rental revenue? So the more information you would be able to provide at that point, the more likely they can see the cause and effect relationship. And remember, the CLA audit agent is just like regular folks. And sometimes they just don't understand it. You buy a property, you buy a property. They're not business people. They're government employees. They don't see things the same way as we see things. So sometimes they get rejected. But to me, the most important part as an accountant, I still deduct it. I would make sure myself keeping track of all the invoice and keep a copy of everything. When it comes down to that, I would then I would still fight with him. That's how I would approach membership fees and events. But I would keep in the back of my mind, sometimes it's not worth fighting. You can fight one time, two times. If you have to bring it to the court, then that's going crazy. You would not want to pay for the cost for deducting a couple $1,000s of membership fees. So that's also important. Now, I saw some questions about auto mileage, but I was just skimming through it. I wasn't sure if this would answer all the questions. Auto mileage is also one of those things that you incur for the purpose of running your real estate portfolio. Now, it gets a little bit more complicated just because some people do house hacking. They live in the same house as a rental as well. So they may live upstairs and then the basement is rented out. Just in the case as my videographer who's only 25 and bought this house with his fiance, they have to rent it out. Otherwise, they wouldn't be able to afford any house to begin with. And if you only own one rental and that rental is in your basement, you cannot deduct any auto mileage expense. Okay. Now, the way that's being deducted in your personal name could be slightly different from the way that's being deducted in the corporation if you own all your if you own all your properties in the corporation. However, either way, you should always keep the guest receipts, your annual auto insurance bill, your 407 ETR bills, or any expenses that you incur for the purpose of maintaining your vehicle, and a logbook. If you're leasing your car, you need to keep the initial lease document and purchase agreement. You also need to keep the license and registration receipts, and even the finance fees if you are financing the purchase of your car. Those are extremely important. But the most important part is the logbook here, the logbook. Now, what is a logbook? Logbook is essentially a documentation of the mileage that you've driven throughout the entire year. The way that auto expenses are being deducted, there are two ways. The first way is that based on the mileage that you've driven for the purpose of running your rental property, let's say throughout the year, you drive 20,000 kilometers in total, your car. So the way that they keep track of it is that at the beginning of the year, you're supposed to take a picture of your odometer. It may say 0. And then at the end of the year, it's 20,000. So you take a picture of it. And then so now you have a base to do the calculation. So the logbook is in your logbook, you're going to say, hey, on January 31st, I drove to this particular property to maintain the property, to inspect the property. And February 1st, I go to this particular property to meet with prospective tenants. So all these things add up, and then the total mileage you've driven for the purpose of running your portfolio. So maybe that worked out to be 5,000 kilometers. So 5,000 kilometers was incurred for the purpose of maintaining your portfolio. 5,000 divided by 20,000, that means 25% of your vehicle expenses, of all these expenses in front of you, would be tax deductible. Now, the second way to do it is easier. You take that 5,000 kilometer and multiply by the CLA tax allowance, CLA mileage allowance. Every year, the number gets a little bit different. And this year, I believe the first 5,000 kilometer that you've driven for the purpose of running a business, you get reimbursed for 61 cents. You get to deduct 61 cents per kilometer. I think so. So anything above and beyond, I think it's 59 cents. So it's still a decent deduction, but the key here again is that logbook. Now, home office expense is tax deductible. Now, the most recent tax folio, income tax folio that came out says that home office expense is deductible against rental income as well. But sometimes the judge doesn't agree with it. Again, this is something more controversial and more on the gray area. If you already have a business, let's say if you already have an office space, I use my office also to manage my portfolio. I would not be allowed to claim the home office expense. Even though I work at home part-time to manage the business as well. So it really goes back to the primary office location. For those of you who do not have a primary office and it is at home, you would be able to claim home office expense. Now, what do you need to keep and what do you get to deduct as home office expense? Similar to running a regular rental, you would be eligible to deduct any expenses that you incur for the purpose of the home. So that means like utility bills, property tax bill, insurance documents, insurance bills, mortgage expenses as well, some maintenance expense as well. Now, the key here though is that you're only allowed to deduct the portion that's used for the purpose of running a portfolio. So typically, if you have but if you have a house that's about 1,000 square feet and you're using one of the bedrooms as the dedicated space for your home office, then 100 square feet is the size of that bedroom. If you take 100 divided by 1,000, 10% of your utilities, property tax, insurance, mortgage, expenses, and maintenance, and the home internet would then be tax deductible against your rental income. Now, the thing is, you also would be required to keep a copy of your floor plan. The reason is because CRA wants to see how much space you are assigning for the use of your use of as home office space. Every time you get audited for home office expense, the way that but my clients got audited, the first thing that they ask for is the floor plan. So make sure that you keep a copy of the floor plan. Now, typically by this point, the next question that people ask me is, if I deduct home office expense, would I need to pay capital gain tax on the sale of my primary residence? Well, the answer is, again, it depends. The reason, if by deducting home office expense, you will push yourself over to trigger the capital gain tax, I probably would not even claim the home office expense. Now, let me explain. If you have a house that you fully use for your own primary residence purpose, there's no rental reason, no other business reason, and this is the only thing that you're deducting, and you're deducting 10%, then typically there's no issue. However, when I first got started with my accounting practice, the income isn't quite strong wasn't quite strong at the time. I rented out my basement. And so I had the two standard subdivision home that's 2-story high, and then I have a walkout basement. So 3 floors. I rented out 1 floor already. So my house, 1 floor is rented out to a third party unrelated to us. And then if I claim home office expense as well, all of a sudden, depending on the size of my home office, it can easily trigger the capital gain tax on my primary residence. The one thing that you have to remember, to claim primary residence exemption on the sale of your own home, you have to obviously live in there, but the house also has to be primarily used for the purpose of being your residence, your home. If you rented out 50% of your house and then also use one of the room as your home office, then obviously you're not using it maybe tip you over to 55% or 60% as for home office as well as your basement rental. Then all of a sudden your house is no longer primarily used for your home as your primary residence, and therefore only the portion that's used by you as the primary residence would be tax exempted. The other portion it would be subject to tax. So depending on your particular situation, this could be something that's worthwhile speaking to your accountants about. Okay. What other documents you would also need to keep just in case of audit? So I've laid it all out here. I'll let you read it when you watch the videos later on. Now, I think I got some questions before on how to do the bookkeeping or how to store your paper record, because I keep telling you guys to keep the receipts. I need to be able to provide you with some format to for your storage as well. A lot of the people can simply just use your an envelope, a brown envelope with the year specified, with the property address specified. Everything that's related to that property could just go into that envelope and it could just go back there. You don't need to scan everything. That's a misconception. Although a lot of the information right now is done electronically, but you do not need to go back. You could go old school just with one envelope. It would make it work. Now, I have everything pretty much electronically saved. I have one folder for one property. I have the year. I have the year as my subfolder, and then all the properties is under that particular year because it would help me to look for the information I need easily. And then I also have the bank information, the mortgage application information for each bank. So those would be my folders when I use computer-based system. Now, you can also use paper-based and computer-based together, because some of the lawyers that I work with, they still send me a package, a stack of paper every time we close. So I would still keep those paper as a backup in paper format, but I also scan them. Now, sometimes people ask me what type of software that I use to keep track of all my receipts. Actually, these two are the one that I'm using, and I recommend them both to my clients. One is called HubDoc, the other one is called Dext. What it does is essentially you could just use your phone and use the app and take a picture of your news and entertainment receipts, and then automatically this can be published to the internet, and then the app would be able to recognize it's Tim Hortons. And then you will be able to book it, log into HubDoc, or your bookkeeper can log into HubDoc and do the whole QBO transactions for you, do the whole bookkeeping for you from the other end. So these apps would allow you to essentially streamline your tax receipts collection process. Other streamline tips, I typically mention one bank account, one property if it is possible. It is easiest when you own everything in personal name. It makes it so much easier to look at the cash balance, and then you know if the property is making money. If it's not possible in the corporation, I typically have one bank account for multiple properties, because it's just too expensive to maintain multiple bank accounts in the corporation. All the expenses are paid through these bank accounts just for clean cut. Remember, I mentioned to you line of credit interest. You would be able to deduct the line of credit interest if you use the line of credit for the purpose of investment. So the way it works is that you take the money from your line of credit, a portion of it goes straight to the lawyer for closing, and a portion of it may go into a dedicated bank account just for the purpose of maintaining a float for that particular property or paying for repairs, initial repairs. If that account is dedicated for one purpose only, which is for the purpose of investing, then the interest that you incur on the line of credit would be easily written off. But then if you mix everything in one bank account, as in the case of one of my clients who mix everything in one bank account, the worst is that he mixed it with his wife. It's a joint account, and everything goes through the same account. It makes it hard for us to do audit or to support his claim on certain things. So if you are not able to open multiple bank accounts, it's important to at least have one dedicated bank account just for investment purpose. Now, all rental income should go into that dedicated bank account as well. And I personally have a couple of rental properties, and sometimes a couple of them are student rentals. And back then, they give me checks. I tried the bank service because bank would be able to bank would be able to deposit your checks, post-dated checks on the first of every month for you for a nominal fee, like $1 each check. So I dropped them off with my branch, and they the month after, they lost all my post-dated checks for the full year. The bank lost them, and it's bad. And ever since then, I stopped trusting my bank. I started taking pictures and using the phone app instead. But because I have so many tenants in those student units, not because I have 27 doors, it's just because the tenants in each house there are 6 tenants in each house. So I started using them. It's a lot of time to log in and log out and to take pictures of these. So what I have done over the year is to have a dedicated email address and leverage the use of auto deposit function on Interact e-transfer. So I would set up the address at gmail.com, and I would set up an auto deposit with Interact, and then automatically deposit it to this Birchwood dedicated bank account. Jacobson, same thing. And by the way, my Gmail address is not Cherry Chen, because I wasn't one of those that registered early enough. I'm just using it as an example. If you want to send me an email, don't send it there. It's not there. It wouldn't reach me. But essentially, I would be able to use that format to automatically deposit the money that my tenants send me. And I've been doing so for my corporation. Immediately, it smooths out all my login and log out. I don't know about you, Interact e-transfer only allow me to accept one Interact e-transfer each time. So I have to always log out and log back in, log out, log back in, log out, log back in. But by setting up the auto deposit, it allows me to just receive the money. I don't even need to think about it. Now, the other thing that I did, which is a big jump as well, helps me with automation, is Pluto. Pluto is an app that allows me to link directly to the bank, and it allows me to collect rent directly from the tenant's bank account. So you can see some of the names, and then also the tenant's bank, like the address of these. I automatically get fetch the money from their bank account, and once it's set up, they sign the pre-authorized debit agreement. Pluto pulls the money directly from them on the first of every month. I don't have to remember it, and it takes money and from the tenant's bank account and deposit it directly into my bank account. So we try to push that into this particular system. And Pluto could also be used to pay for my repairs, pay for my contractor. It could move more than $5,000 or $10,000 at maximum a day with Interact. So this helps me to essentially control and manage everything using a button on my phone. And that's pretty much all the tips that I have to streamline your business. Oh, don't forget about your free book. If you haven't got it yet, you are, as a thank you to Elizabeth to host this awesome webinar, you will receive this best-selling book from me, soft copy. If you go to realestatetextips.ca/investors, and you will get a free copy. Now, this is second part. Let me just take a sip. I can't believe it's already 50 minutes that I not stop talking.
I asked the group if people are okay if we let you go right till 12:55, and then we'll figure out a way to answer some of these questions, whether we capture them and in the follow-up email we're sort of put links into your blog where this kind of stuff is answered. Like there's so much good information. I really should have. We can do a part 2.
Yes, we can do a part 2. Absolutely. But let's get started with this, and I have 7 minutes, right?
Yep, unless people want to stay a couple of minutes late, we can let you go right to 1 o'clock, and my wrap up takes about 5 minutes. So
okay, sounds good. I'll do that then. Thank you. Thank you. Sorry for squeezing your time.
No, it's
okay.
Good. It's good. I think I have a solution in my brain. So you have
awesome.
11 minutes.
Okay, thank you. Now, So before we step into deciding whether you should set up a corporation to invest or not, we should get a better understanding of how our personal tax system work and how our corporation tax system work. If you don't understand it, there is no way that we would be able to decide whether you should set up a corporation or not. And it really goes back to your particular situation and your long-term goal. Now, our personal tax system, we generally tell people that it is a progressive tax system, which means that the more you make, the more tax you have to pay. Now, for this in front of you is the 2022 tax bracket. Some of them are grouped together, but essentially between $13,000 to $46,000, you pay 20% of tax. Between $46,000 to $50,000, you pay 24% tax. If you are someone who's making $150,000, then we have to essentially, as an accountant, our software help us to calculate the difference between 13 to 46 and multiply by the delta. Take that delta and multiply by 20%. And then we go through every single marginal tax rate to come up with your income tax liability. In this particular situation, here is the calculation. So you would owe, you would owe $45,000 personal tax. Now, if you do the same math, if you were to earn an additional $50,000 from your employer, that additional $50,000 is going to be subject to a little bit of 45% tax, and then for majority of it is going to be taxed at 48%. So essentially, you get taxed for an additional $22,500. Even though your bonus that was given to you is $50,000, the true after-tax amount is only 55% of the $50,000. You gave almost half away to CRA if you report everything to in your personal name. Now, corporation tax system, this is how it works. If you earn active business income, so what is active business income? Active business income refers to, like, for example, an accounting practice is earning active business income. If you flips properties, they are considered active business income. If you do some of the rent you own would be considered active business income as well. So those are active business income, and active business income for majority of us we are only paying 12.2% inside the corporation. Now, when you take the money out from the corporation, you still have to pay personal tax, don't get me wrong, but you have a lot more flexibility, because even if I just do 12.2%, let's say I make $100,000, I pay 12.2% in the corporation, and I only take out whatever I need to live my personal life and leave the money in the corporation, you can save a bunch of taxes, defer a bunch of taxes for your investment, for the purpose of investing for yourself. What it means is that you are taking CRA money, the money that you would otherwise pay to CRA as personal income tax, and you turn around and take that money and invest on your behalf and make money off that. Keep in mind that that's tax deferral. Eventually, when you take the money out from the corporation, you would still have to pay some taxes. But depending on your tax situation, we could even minimize the amount of personal income tax that you would have to pay over time. So there is a substantial tax benefit by setting up a corporation to do certain type of real estate investments. Now, however, not everything is specified, considered active business. And here are the income that is not considered active business income. Now, these are called specified investment business income, and generally they are referred to as passive income. Specified investment business income includes rental income, taxable capital gain, dividend income, royalty income, and interest income. They're not taxed at 12.2%, but they are taxed at 50%, 50%. Then everyone at this point would want to ask me, like, then why would I want to set up a corporation? There are many other reasons to why you want to set up a corporation. But before you get too upset about this 50% tax rate, one thing that I want to remind you is that out of the 50% tax rate that you pay, 30% would be refundable if you pay a taxable dividend to the shareholder. And the shareholder would then have to report the dividend income received. That's why it's called taxable dividend. Now, over time, the tax on the rental income is only 20% inside the corporation, but you do have to pay tax on the personal dividend received. The way, oops, am I going too fast? Let me see. So you issue a taxable dividend. The way it works is that the shareholder receives the dividends, and then the company issues a T5 slip. You and I both have experience, majority of us would have experience receiving a T5 slips from some investments that we made in the public market. But in this case, the T5 slips is issued by the corporation that you own, and you report that income as part of your personal income tax and report it as your dividend income. Shareholder has then to report the dividend income as personal income added to the personal tax return, and then we'll have to pay also personal tax. Now, total taxes that would be paid is the corporation tax 20% plus the personal dividend tax. Questions is always like, hey, then I may be double taxed then. No, well, the reality is that our income tax act is designed in a way that there is tax integration, and the tax integration means that you would not need to pay double tax. Typically, tax integration is also not perfect. They may be if under personal ownership, the personal tax that you pay would be more or less the same amount as if you were to have it in the corporation, own it in the corporation, and pay personal tax and corporation tax ultimately. Now, the reason why it is not double tax is because the government taxes you less. You can see that when you receive the Canadian dividends from your corporation, typically the tax rate is a lot lower than the other income, the regular income tax rate. They give you all the lower tax rate on it. So depending on your particular situation, there are a lot of advantage of operating under these lower tax bracket if you are not making as much money and staying under within those tax brackets. Corporation can save you a lot of taxes if you structure it correctly. Now, here are the 6 questions to decide whether you should set up a corporation or not. First one is, what is your investment strategies? Like I mentioned to you before, if you're doing assignment, flips, land development, rent to own, or even a lot of wholesaling, they are considered 100% taxable. They are income. They are not part of the specified investment business definition. So you don't pay 50%, you pay 12.2% on these. If you own this and do this as a business, make sure that you do it directly in the corporation because it provides you legal protection and it gives you 12.2% tax. Now, if you buy long-term buy and hold, and it depends on the number of properties that you are aiming to buy, you may still want to buy them in the corporation. And corporation may provide you some mortgage benefit as well. If your property sale is considered income, much better to be in the corporation. Now, do you want legal protection? That's the second question that I always ask my client. People always come back and say, well, I have policy, home policy. Why do I need extra insurance? Well, because you don't know what you don't know. Let's imagine that this big white rectangle is your entire portfolio. Everything is owned in your personal name. This is all your personal holding. Everything can be at risk if your rental portfolio starts suing you. One of your tenants or one of the patrons slip and fall on the back stairs and wanted to sue you. Everything that you own in your name could be exposed to that risk. Do you really want to expose everything in your personal assets to that particular, lack of a better word, idiot that accidentally fall? Now, but if you separate everything, this is one bucket, this is another bucket, this is another bucket, then everything the risk is contained in one bucket individually. The business is also contained. The business risk is contained in its own corporation. The rental portfolio is contained in its own corporation. You are limiting your risk. You are playing for upside. Right now, if you own everything, you may not be doing that. Some people even go as far as setting up a family trust as well. Third question, are you planning to buy more than one property? The reason is because there is a cost associated with setting up a corporation and also tax filing as well. If you do planning to buy one property and there's only one single family home and you're happy with it, you don't have a huge goal, then it may or may not make sense to set up one corporation just to file one tax return for one single family home. And that's the reason why I always ask my clients, what are your long-term goals? If your long-term goal is to do just one property, don't worry about setting up the corporation. Now, also the other thing is when you set up a corporation, if you are planning for big plans and you buy multiple like many properties, tens of properties, at least as your long-term goal. I have a client who just started this process. They purchase all their properties inside the corporation, qualify directly in the corporation's name. So they buy the first 5 properties in corporation with Scotiabank, and then they go to a different bank and ask for mortgage financing. Sometimes these banks ignore what they own in other corporation and qualify you for financing as well. So those are strategies that would only be available if you buy them in the corporation. Essentially, you are maximizing the use of your personal credit without you doing anything illegal. So, and minimizing the interest cost as well. So that's the benefit of having it in the corporation. Now, do you own another small business? I fund my purchase all using my small business profit. I have my accounting practice. I pay 12.2%. If I were to take it out to my personal name, it costs me more money. And then I know it's 1 p.m. Just let me finish this point, and then we'll wrap it up. So if you have that small business, you are using the money from CLA to invest on your behalf within the same corporation structure. That's going to help you a lot in the long run. And then I am going to stop here and let Elizabeth Kelly to take over.
Awesome. Thank you, Cherry. That was awesome. That was really fantastic. I enjoyed that very much. So here is where you can reach myself and of course, Cherry. And actually, you know what, that goes in really well with my final slide for today. Thank you so much, everyone, for attending. And the question that I wanted to ask everybody was, due to unforeseen circumstances, there is not a guest at this point for the February 14th webinar. So what do you guys think? Should we bring Cherry back to do the second part of her presentation? Are you free, Cherry? We're putting you on the spot here. But if we can make that work, would you guys like to spend your Valentine's lunch with Cherry and I?
I may have to double check with Erwin. That's too funny. I didn't even realize it was like Valentine. It's just February 14th. Let me check. When you make the comment, it's just way too funny.
Well, it looks like the landslide opinion, Cherry, is they want us to be their dates for Valentine's Day. That's what it looks like.
Okay, sounds good. I can assure you, Erwin did not make any plans.
I tell you what, I'll buy Erwin lunch if he lets you come on February 14th and spend Valentine's with us. This was absolutely amazing. Thank you so much for your time. We appreciate it. And I know you'll have more amazing content. And there's 30 questions right now that I will probably grab some help from you and your team to try our best to answer in our wrap-up webinar, whether we provide links to your blog that addresses people's specific questions or whatever. Guys, thank you so much for attending. I love what I do. It's so great to see everybody out here learning and being sponges and grasping more information.
Thank you so much.
Oh, it's our pleasure. Thank you so much, guys. Have a fantastic day. I'll let you get back to work. I'm sure you guys have some things to do to keep yourselves busy. Take care. All the best. We'll chat soon. And Cherry, we'll connect offline and see what we can arrange for the 14th.
Awesome. Bye.
Take care, guys. Bye-bye.